clearly the economy is slowing, and so all of the economic factors are now beginning to move in various degrees in gold's favor. But most North American investors have not been looking at gold because the economic environment has just not been conducive to it. The miners are obviously doing incredibly well for investors, for serious investors. The miners are doing well, and they can see the growth in the cash flow, growth in the margin that is leading to growth in the cash flow. And it's, for a lot of companies, there's free cash flow, which is, an unusual thing for gold mining companies. So people are beginning to see that. And again, that was not just 1 quarter or 2 quarters. That's now been 6 quarters of increasing cash flow on very, very strong margins.
The economic slowdown is starting to favor gold, prompting renewed interest from North American investors who had previously stayed away due to an unfavorable environment. Gold miners are performing exceptionally well, with 6 straight quarters of rising cash flow and strong margins, something rare in the sector. This is drawing serious investor attention. Meanwhile, silver appears to have established a new price floor around $30 to $33, indicating strength, though a rapid surge to $50 or $100 isn't expected just yet. Adrian, a respected economist and investment advisor, notes that central banks, especially China, remain the biggest buyers of gold, with China continuing its purchases for the 8th straight month. Central banks globally are projected to purchase 900 to 1,000 tons of gold in 2025, marking the 4th consecutive year above 1,000 tons, a trend driven by de-dollarization, geopolitical uncertainty, and growing distrust in U.S. assets. Analyst forecasts from Metals Focus, World Gold Council, and others indicate that this pace of buying reflects a structural shift in reserve strategy away from dollars and toward tangible assets like gold. Notably, survey results show that 95% of central banks expect reserves to increase over the next year, and 43% plan to add more gold in 2025, up from 29% in 2024. While North American central banks, such as Canada and Mexico, aren't the primary drivers, they remain part of this broader official sector accumulation trend. North America is also contributing meaningfully via increased mine production forecasts, particularly in Canada, Artemis Blackwater, B2 Gold Goose, and California, Caliber Valentine, with North American output expected to rise approximately 19% in 2025. Gold is gaining more investor attention as its price continues to climb, and gold mining companies show strong cash flow and profitability, something rare in the past. This trend has lasted for 6 quarters now, attracting serious investors. Retail and institutional investor demand in North America is surging. Gold ETFs received over $21 billion in Q1 2025, the second highest quarterly inflow on record. VanEck Gold Miners ETF have jumped approximately 34% year to date, outpacing physical gold gains. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
We did have, a few months ago, we did have a bit of a pause from several, or slowdown in the buying from several of the central banks. But central banks are still far and away the largest driver. But of course, it's all what happens at the margin. If they used to buy X and now they buy X minus 10, that matters. But the central banks are still buying. China, as you know, in the latest numbers that came out yesterday, China's still buying. That's the 8th month in a row that they've been buying, because they paused last fall. So they're still the main buyer. Where we've seen a bit of a change recently, or the biggest change recently, is with the non-official Chinese sector. That buying, which shot up in the spring, has subsided. Early spring has subsided. I don't know that that's permanent. It's probably coming back. But the next move, it seems to me, is with North American investors, not the Ray Dalios and Bill Druckenmullers and so on, but ordinary not just retail investors, but investors, family offices, small institutions, investment advisors telling their clients, money managers, etc., all of that. So I think the next leg is going to be the North American investors who've really been out of this market. No, that's an excellent question. I think the first thing that's causing people to look is simply the fact that gold has moved up so much for so long. And so, when it started to move up, people didn't really notice. And then you sort of notice, but say, oh, it's only temporary. But I think now the miners are obviously doing incredibly well for investors, for serious investors. The miners are doing well, and they can see the growth in the cash flow, growth in the margin that is leading to growth in the cash flow. And it's, for a lot of companies, there's free cash flow, which is an unusual thing for gold mining companies. So people are beginning to see that. And again, that was not just 1 quarter or 2 quarters. That's now been 6 quarters of increasing cash flow on very, very strong margins. So that's getting attention. But I think what's going to drive it looking forward, okay, step back. Remember, a typical North American investor buys gold, and by gold I'm now talking about gold assets, generally, when the economic environment is right, when the economy is slowing, because you think that means the Fed will start cutting rates, when inflation is high and increasing, when rates are low and being cut, and when the dollar's falling. So that's the perfect economic environment to be looking at gold. And that's the precise opposite of what we've had for the past several years. So it's no surprise to me, it's not illogical, let's say, it's not illogical that most North American investors have not been looking at gold because the economic environment has just not been conducive to it. But as I see it, all that's beginning to change. The dollar's obviously down a lot this year. It's oversold, it's significantly oversold on the short term, in my view, but that's a different subject. But the point is the dollar's been falling after being consistently strong. Inflation is sort of, well, it's not under control, and Jerome Powell, the Fed chairman himself, is concerned. So if he's concerned, shouldn't we be concerned? There's indications that there's more indications that the economy is slowing, both the consumer spending. If you look at the patterns of consumer spending, are they spending on necessities, or is there a lot of consumer discretionary spending? There's no consumer discretionary spending. And so that's a bad sign. And of course, the jobs market is nowhere near as strong. If you look under the hood, under the bonnet, it's nowhere near as strong as the headlines would suggest. And we can, you only have to look at the revisions to see that that's true. So clearly the economy is slowing, and so all of the economic factors are now beginning to move in various degrees in gold's favor. And the only thing holding up at the moment, of course, is the S&P in the stock market. And but you're seeing the Magnificent Seven are all starting to roll over, or most of them are. And so that's making people look for other places to put their money.
Right. And it is the Magnificent Seven who are mainly providing that support, right, for the S&P. So if they start to be turning down, then the whole thing would follow.
No, well, I'm not looking for a market crash anytime soon. One never knows, but that's not my base case. We're already seeing the market breadth is bad, but it's not as bad as it was at the end of the year. So we're already seeing that there is some dispersion, and there are some stocks doing well in the S&P other than the Magnificent Seven. It's not as bad as it was. We're already seeing some money flowing into European stock markets. Europe, of course, but the European markets have outperformed the US this year. That's the first time in many, many, many years. So and that's because of the flows. We're seeing flows from US into Europe, but we're also seeing a lot of the steady flows from Europe into the US market are slowing. And I think that's a major theme, frankly, going forward, that a lot of the money from abroad that would typically just flow regularly into the US stock market, I think we're going to see that slow dramatically and even reverse in the face of a lower dollar, in the face of tariffs, in the face of just the general, I don't want to say hostility, but the general government attitude towards foreign investment. So I think we're going to see that reverse.
Adrian Day predicts gold may face a short-term pullback due to factors like upcoming trade deals, stronger economic data, or geopolitical developments such as new Abraham Accords members. While gold has climbed to $3,500, it hasn't seen a meaningful correction in years. If a dip happens, it could be a strong buying opportunity, especially with central banks still diversifying away from the US dollar. In the long term, the outlook remains very bullish due to global de-dollarization, geopolitical tensions, and shifting economic conditions. Gold stocks are already performing well, and once more institutional and retail investors join in, the market could see a powerful surge, especially as smaller mining stocks start outperforming larger ones. Moreover, silver appears to have established a new price floor around $30 to $33, signaling a more substantial base than before. However, a surge to $50 or $100 doesn't seem imminent. Most silver is produced as a byproduct of other metals like zinc and lead, making supply unresponsive to price changes. Additionally, there are no significant stockpiles of silver, so any sudden surge in demand, especially from retail investors, could trigger sharp price spikes. For now, inflows into ETFs and coin dealers remain steady but not explosive. A dramatic move in silver likely requires a wave of retail buying, which hasn't happened yet. Now, let's recall the interview.
Obviously, with any market at any given time, there's lots of factors, right? Some bullish, some bearish, and it's a matter of trying to weigh those different factors. Where we are right now, first of all, July and August have, for the last several years, for the last 15 years, they have been seasonally strong months for gold, so that would sort of maybe weigh against it. We've already had a pullback from 3,500 to 33. Okay, that would weigh against a further correction. But on the other hand, you could see a confluence of factors that are not completely out of a realm of possibility. I'm not talking about a balanced budget, but a confluence of factors in the near term that could cause gold to correct a little bit more. We really haven't had a proper correction in gold. The 3,500 was a bit of a spike. I know it did get there, it's real, but we really haven't had a proper pullback in gold for the last 3 years. If you get, what are they talking about? Is it 8 or is it 10 trade deals going to be announced very, very soon? Or was it 7 or was it 11 or was that yesterday or was that this morning? But anyway, they're talking about if you get a bunch of trade deals announced with important partners, like Japan and Korea, and the EU has said now that we're close to a deal. So if you get trade deals announced, if you get some more reasonably positive news on the economy, so that interest rates are not going to be cut again. If you get some more Arab countries, particularly say Saudi Arabia, decide to join the Abraham Accords, they've been there's a lot of talk about that right now. A little bit of a steam taken out of demand for gold and cause a bit of a pullback. If we see that over the next, say, 6 weeks, month or 6 weeks, I would see that as an incredible buying opportunity. And it may not even happen, but if you look out 6 months, a year, it's difficult for me to be more bullish than I am, and that itself is a dangerous thing, I realize. But all of the factors that people have been buying gold, the central banks buying gold to diversify out of the dollar in the face of dollar weaponization, I think at the minimum, we can say that hasn't gone away under the current administration. They didn't start it, of course. But when you're threatening tariffs on the BRIC countries because, if you go against us, we're going to tariff you, that's all wildly bullish for gold. Is Brazil going to say, oh, we're so sorry, Mr. President, let's go buy some of your treasuries? No, they're going to say, let's dump your treasuries and buy as much gold as we can. So all of these factors, and then on top of that, you've got the changing economic thing that we talked about, which is going to get more people interested in gold. So any pullback would be a buying opportunity in my mind.
For gold and the gold stocks, I imagine.
Gold stocks as well, yeah. The gold stocks will really take off. We're already beginning to see it. The gold stocks have done well. And it's incredible, but when you see the XAU or the GDX up, 55% or whatever in the last year, and that's in the face of outflows from the GDX, from the GDXJ, that's pretty astonishing. So can you imagine what's going to happen when ordinary investors, and by ordinary, I don't mean just small investors, I mean ordinary investors, that's including money managers, registered investment advisors, and so on, start to buy gold. And we're just beginning to see that. The fact that silver's outperformed gold this year, the fact that the GDXJ has outperformed the GDX, even though the J isn't really juniors, but nonetheless, the somewhat smaller stocks are outperforming the bigger stocks. These are all signs of interest from ordinary, what I'll call ordinary investors, from retail investors.
Makes a lot of sense. So good to go into the gold stock opportunity as well. And on that note, I know that you're a big fan of the royalty companies. Yeah. And I wanted to ask about a little bit of some timely news because we had a deal earlier this week, I believe, the one with Royal Gold, Sandstorm Gold, Horizon Copper. Any thoughts on that? Do you like to see consolidation in the space?
Well, we definitely need consolidation, among the smaller ones. There's too many, and Sandstorm of course, will be in the mid-tier of that, but there's definitely too many of the smaller ones in my mind, because when you're a small company, it means your cost of capital is much higher. And when you're buying royalties, you need access to capital. So it's not like so it's a critical thing. It's not just, I've never been a person that says big is better, but in the royalty space, bigger, not, is really better, because your cost of capital, which is how you build a business. My sense is that we found a new floor, and the new floor is definitely, well, I say definitely, but the new floors are 30 and, perhaps even a 33. So, we've broken out, and I think we've got a new floor at a meaningfully higher number than we were before, perhaps even 33. But I'm not sure we're going to see silver shoot to $50 or $100, anytime soon on this move. I've had people ask me on silver, is this it? The thing about silver, you've got, obviously we know this, you've got the industrial demand, and then on the supply side, you've got the fact that you've got two things that are grossly different or vastly different from gold. First of all, you've got most silver supply is byproduct, so about 75% of silver supply is byproduct, and it's byproduct not of gold, but it's byproduct of zinc and lead. And so I've said this before, the lead miner in Bolivia does not build a new lead mine with 10% silver byproduct just because the price of silver went up, right? And so silver supply does not respond well to changes in the price of silver, which is one of the reasons that the silver price is so volatile. That works on the downside as well as the upside. You don't close your zinc mine because the price of silver went down. The second major difference is there are no stockpiles of silver, no meaningful stockpiles of silver. And so if you get a big run suddenly, there's no big supply to suddenly come on and take that away. And that's another reason why silver moves can be so dramatic. So the setup for silver is certainly very, very good. But in order to get that move, you really need to start getting retail investors come in droves, because when they come in buying silver in droves, and you get inflows into the SAL and so on, the PHYS, spot physical silver. When you start to get inflows into those ETFs and people buying silver coins at the coin dealer, there's nothing to stop it at that point, until it just gets crazy and people who bought at 40 decide to sell at 60 or whatever.
Gold is re-entering the spotlight as economic headwinds, high mining profitability, and central bank accumulation, particularly from China, provide a bullish background. North American investors are becoming more active, with significant ETF inflows and mining stock gains indicating greater confidence in the industry. Meanwhile, silver is showing strength with a new higher price floor, but a breakout to extreme highs will likely require a catalyst such as rapid retail demand. Both metals are heading for significant long-term gains, with short-term dips providing potential buying opportunities. Could a temporary gold price drop be the last significant buying opportunity before a larger surge fueled by institutional and ordinary investors? What event or trend could eventually spark the tsunami of retail silver buying required to drive prices beyond $50? Please provide feedback in the comments section below. If you found this video helpful, give it a thumbs up and subscribe to stay up to speed on our latest content. We appreciate you being a part of our journey.